Most people think silver is rising, but what's actually happening could trap them. You're missing the entire story. Because as of today, April 11th, 2026, silver is trading near 75.6. That number looks strong. It looks stable. It looks like a continuation of a bullish trend. But the reality is very different. This move is not built on strength. It is built on expectation, and expectations can break fast. Right now, the market is reacting to two major developments happening simultaneously. First, growing expectations that the Federal Reserve may cut interest rates later this year. And second, the ongoing U.S.-Iran negotiations, which are expected to continue this weekend. On paper, this combination should support silver. And it has. Silver recently surged nearly 3.7% after a temporary ceasefire reduced fears of energy-driven inflation. But that's only part of the story, because what caused the rally is the same thing that could reverse it. Let's break this down carefully. The Federal Reserve is currently holding interest rates in the range of 3.5% to 3.75%, according to recent FOMC discussions. And markets are beginning to price in the possibility of a rate cut later in 2026. Not guaranteed, not confirmed, but possible. And historically, when interest rates fall, non-yielding assets like silver tend to benefit because lower rates increase liquidity. And liquidity finds its way into assets. But here's where the contradiction begins. Inflation is still elevated. Recent CPI data shows inflation running around 3.3%, the highest in months. And that creates a problem because central banks do not cut rates aggressively when inflation is still unstable. So now the market is caught in between two competing realities. Expectation of rate cuts, reality of persistent inflation. And when markets face conflicting signals, they don't trend, they react. That's exactly what you're seeing right now. Silver is not trending higher, it is oscillating between roughly $74.4 and $76 because traders are not confident. They are positioning, waiting. Now add geopolitics into this equation. The US-Iran situation is not just a political issue, it is an economic trigger. Because this region controls one of the most critical energy routes in the world. The Strait of Hormuz, any disruption there can impact global oil supply. And oil directly impacts inflation. When oil rises, inflation rises. When inflation rises, central banks delay rate cuts. And when rate cuts are delayed, silver loses momentum. That's the chain reaction. Now here's what just happened. A temporary ceasefire was announced. Markets reacted immediately. Oil stabilized, inflation fears eased, and silver moved higher. But that reaction may be premature because the ceasefire is not stable. Recent developments suggest ongoing tensions in the region. Disruptions in shipping routes continue, and markets are already showing signs of hesitation. In fact, silver recently pulled back from intraday highs as traders reassess the uncertainty around negotiations. This is important because it shows something critical. The market does not fully trust the current situation. And when trust is low, volatility increases. This is not a clean rally. This is a fragile move. Now let's go one level deeper. Behind all of this, there is a structural factor that most people are ignoring. Supply. Physical silver availability is tightening. London vault holdings have declined by approximately 2.4%, indicating reduced supply in the market. That may sound small, but in commodity markets, small supply changes can create large price reactions because supply is not flexible. You cannot instantly increase production, and when supply tightens, even moderate demand can push prices higher. So now think about what's happening. You have potential rate cuts, bullish geopolitical uncertainty, volatile, tightening supply, supportive, all at the same time. And that creates instability. Because these forces are not aligned. They are pulling the market in different directions. Now step back for a moment. Silver is not just reacting to one variable. It is reacting to an entire system, a system that includes central bank policy, inflation dynamics, energy markets, global conflict, physical supply constraints. And right now, that system is not stable. It is in transition, which means the current price may not reflect the final outcome. And that is where the risk begins because markets tend to move the most when uncertainty resolves, not when it exists. Right now, uncertainty is high, which means a resolution is coming. And when it comes, the move could be significant. But here's the key question. What exactly is the market waiting for? The answer is simple: the outcome of US-Iran negotiations, because that single event will influence oil prices, inflation expectations, Federal Reserve decisions, global liquidity conditions. Everything connects back to that. And that is why this weekend matters. Not next month, not next quarter, this weekend, because markets are already positioning quietly, waiting for confirmation, waiting for direction. And once that direction becomes clear, the reaction could be immediate, because positioning will shift all at once. And when positioning shifts, price follows fast. So the real question is not why is silver at 75? The real question is what happens when the uncertainty disappears? Because that is when the real move begins. And right now, that moment is getting closer very quickly. Now let's go deeper, because what we just covered, that's only the surface layer. There is something else happening right now, quietly in the background, and it may be more important than everything else combined. While markets are focused on rate cuts and distracted by US-Iran negotiations, a completely different force is building. A force that doesn't depend on headlines, doesn't react to news, doesn't wait for confirmation, physical demand. And right now, that demand is coming from one place, China. So let's be precise, because this is where the story changes. In the first 2 months of 2026, China imported over 790 tons of silver. And in February alone, nearly 470 tons. The highest ever recorded for that month. Think about that for a second. That's not normal demand. That's aggressive accumulation. And it's not just industrial demand. It's both solar manufacturers increasing production, retail investors shifting from gold into silver. Why? Because silver is still cheaper than gold. And in uncertain environments, investors historically rotate into undervalued hard assets. But here's where it gets interesting. This demand is not just increasing, it's tightening global supply. Because when one country absorbs large amounts of physical metal, that metal disappears from the global market. And once it's gone, it's not easily replaced. Now combine that with another factor. China has started regulating silver exports, meaning outflow is restricted, internal demand is prioritized. What does that do? It creates fragmentation. Instead of one global silver market, you start getting regional supply imbalances. Liquidity drops, volatility increases, and pricing becomes more unstable. Even analysts have warned that these changes could make silver more volatile and less liquid going forward. This is critical because most people still think silver moves like a simple commodity, but it doesn't. It moves like a hybrid system, part industrial metal, part monetary asset, part speculative instrument. And right now, all three layers are active at the same time. Now let's connect this back to price. Earlier this year, silver didn't just rise, it exploded. Prices surged nearly 70% at the start of 2026, driven by aggressive buying and speculative momentum, but then something happened. The market corrected violently. In fact, silver hit extreme highs above $110 and then collapsed rapidly, dropping toward the $70 range within weeks. That kind of move is not normal. That's not a trend. That's a reset, a forced unwinding of excess speculation, and this is where most people misunderstand the market. They look at that drop and assume weakness. But in reality, corrections like that often serve a purpose. They remove leverage, they shake out weak positions, they reset pricing, and once that reset is complete, the market becomes more stable, more sustainable, more dangerous, because now the next move is not driven by hype. It's driven by structure. And structure is harder to see. Right now, that structure is forming. On one side, you have macro uncertainty, Federal Reserve decisions, inflation pressure, geopolitical instability. On the other side, you have physical tightening, China absorbing supply, industrial demand rising, export restrictions building. And in the middle, you have price, trying to balance both forces. That's why silver is stuck. Not because nothing is happening, but because too much is happening at the same time. Now think about this carefully. If geopolitical tensions ease and rate cuts begin, liquidity increases. That would normally push silver higher. But what happens if at the same time physical supply is already tight? The move doesn't just continue, it accelerates, because now you have demand increasing, supply decreasing. That's not balance. That's pressure. And pressure builds until something breaks. Now here's the other side. What if negotiations fail? What if oil spikes again? What if inflation rises instead of falling? Then central banks delay easing, liquidity stays tight, and financial demand weakens. But physical demand? That doesn't disappear overnight. Industrial demand doesn't stop. Solar production doesn't pause. Investors don't suddenly reverse. So now you have a different kind of imbalance. Weak financial demand, but strong physical demand, and that creates confusion because price doesn't move cleanly in that environment. It becomes unstable, volatile, reactive, which is exactly what we are seeing right now. Silver is not trending. It's responding to every headline, every signal, every shift. And that kind of market is extremely difficult to read because it's not about direction. It's about timing. And timing is everything. Now, here's the part most people miss. Markets don't wait for clarity. They move before clarity arrives. Right now, we are in that window before clarity, before confirmation, before the real move. And this is where positioning happens, quietly, without attention, because the biggest moves are often built when the market looks uncertain, not when it looks obvious. So while everyone is watching or headlines, negotiations, price levels, the real story is being written somewhere else, in physical flows, in institutional positioning, in liquidity expectations. And those factors do not update in real time. They build slowly until suddenly they don't. And when that shift happens, it doesn't announce itself. It just moves fast. And by the time most people notice, it's already too late. So now the question changes again. It's no longer, why is silver at 75? Now the question is, what happens when physical pressure meets financial demand at the same time? Because that scenario does not create stability. It creates acceleration. And that moment may be closer than it looks. Prices are moving, headlines are changing, volatility is rising, and yet the biggest players in the system are still not fully committed. That hesitation matters, because historically the largest moves in financial markets don't begin when everyone is active. They begin when the biggest capital is still waiting. And right now, that's exactly where we are. Silver is trading around the mid-75 range after touching nearly $76 recently, but instead of accelerating, it's holding, not breaking out, not collapsing, just holding. And that kind of behavior usually signals something deeper beneath the surface. If you look at the structure carefully, you'll notice something important. The price has already experienced extreme volatility this year. Silver surged to historic highs above $120 earlier in 2026, and then corrected sharply, dropping more than 30% within weeks. That kind of move resets the market. It removes leverage. It clears out speculation. But more importantly, it forces institutions to step back and reassess. Because when a market becomes unstable, large funds don't chase it. They wait for clarity. And right now, clarity hasn't arrived yet. This is where the role of institutions becomes critical. When we talk about markets, we often focus on traders, retail investors, and headlines. But the real influence comes from large entities, central banks, sovereign funds, global asset managers, and macro hedge funds. These are the participants that move billions, sometimes trillions, based on long-term positioning rather than short-term reactions. And at this moment, many of them are still watching. because they are not just analyzing silver. They are analyzing the entire global system. Think about what they are looking at. On one side, you have the Federal Reserve, which is still navigating a complex inflation environment. Inflation has eased compared to previous peaks, but it remains above long-term targets. That means the Fed cannot aggressively cut rates yet, even if growth is slowing. And when central banks hesitate, liquidity remains constrained. And liquidity is the lifeblood of markets. Without it, large-scale capital flows slow down. At the same time, global institutions like the IMF and World Bank have already warned about slowing global growth due to geopolitical tensions and rising energy costs. This is not just a regional issue anymore. It's systemic, because energy prices influence everything, from transportation to manufacturing to consumer prices. And when energy remains elevated, inflation remains sticky. And when inflation remains sticky, central banks delay easing. Now layer that with what's happening right now. The US-Iran negotiations are not just political discussions. They are macroeconomic events. Because they directly influence oil supply, and oil supply directly influences inflation. And inflation determines central bank policy. And central bank policy determines liquidity. And liquidity determines asset prices. Everything connects. And that's why institutions are not rushing into silver yet, because they are waiting for that chain reaction to stabilize. Even in the last 48 hours, markets have shown signs of hesitation. Silver pulled back slightly from recent highs as investors reduced exposure ahead of the weekend talks. That is not fear. That is positioning. Big money does not move impulsively. It adjusts slowly, carefully, based on probabilities. And right now, the probability is unclear. At the same time, the broader financial system is showing mixed signals. Equity markets have been unstable. Oil prices remain elevated near $95 to $96 per barrel, even after recent dips. That means inflation pressure has not disappeared. It has only paused, and markets are trying to decide whether that pause is temporary or permanent. This is where volatility becomes important. Volatility is not just random movement. It is a reflection of uncertainty. And right now, uncertainty is extremely high because the market is trying to price in two completely different futures at the same time. In one scenario, negotiations succeed, oil stabilizes, inflation cools, and central banks begin easing. In another scenario, negotiations fail, oil spikes again, inflation rises, and central banks remain restrictive. Both outcomes are possible, and until one becomes dominant, price will remain unstable. Now here's the critical part. When institutions face uncertainty, they don't exit the market completely. They reduce exposure, they hold cash, they wait for confirmation. And when confirmation arrives, they move fast. Because large capital does not trickle into markets. It flows. And when it flows, it creates momentum. Right now, that flow is not fully started, which means the current price may not reflect the real move yet. It may only be the beginning of positioning, because once institutions gain clarity, they will not hesitate. They will act. And when they act, the market will not move slowly. It will reprice. There's another layer to this that most people overlook. Silver is not just influenced by financial demand. It is also influenced by industrial demand. And that demand is not cyclical in the same way as financial flows. It is structural. Industries like solar energy, electric vehicles, and electronics continue to consume silver regardless of short-term market conditions. That creates a baseline level of demand that does not disappear easily. So now think about what happens when financial demand returns on top of already strong industrial demand. That's when pressure builds. Not gradually, but exponentially. Because supply cannot adjust quickly, production takes time, mining capacity cannot expand overnight, and when demand exceeds supply in a constrained system, price reacts. Right now, that pressure is building, slowly, quietly, without attention, because the market is still focused on headlines, on negotiations, on short-term movements. But beneath that surface, the structure is tightening. And when structure tightens, it eventually breaks. This is why the current moment matters, because we are not in a confirmed trend. We are in a transition phase, a phase where the market is shifting from uncertainty to clarity. And that shift is where the biggest opportunities and the biggest risks exist. Now ask yourself this. If institutions are waiting, and physical demand is steady, and geopolitical uncertainty is unresolved, what happens when one of these variables suddenly changes? What happens when clarity arrives? Because when it does, the hesitation disappears. And when hesitation disappears, movement accelerates. Right now, we are not at the end of the move. We are at the edge of it, and the market knows it. That's why price is holding. That's why volatility is rising. That's why participation feels uneven, because everyone is waiting for the same thing, confirmation. And that confirmation may not come gradually. It may come suddenly through a statement, through a decision, through an event. And when it does, the market will not give time to react. It will move first and explain later. So now the question becomes more important than ever. Not where silver is today, but what triggers the next phase. Because that trigger is already forming. Right now, behind the scenes, and when it finally appears, it won't look obvious at first, but it will change everything. At this point, the story is no longer about what has happened. It's about what is about to happen. Because everything we've seen so far, the volatility, the hesitation, the reactions, all of it is building toward a single moment. A moment where the system stops balancing and starts choosing a direction. And when that happens, markets don't move slowly. They reprice. Right now, silver is sitting inside that pressure zone, around the mid-70 range, not breaking higher, not collapsing lower, just compressing. And historically, compression like this doesn't last. Because when too many forces push in opposite directions, something eventually gives. Let's go deeper into the structure, because this is where the real signal is hiding. Global silver demand is not weak. In fact, according to the Silver Institute, physical investment demand is expected to rise by nearly 20% in 2026, reaching around 227 million ounces, even as other sectors fluctuate. At the same time, the market is still running a structural deficit, meaning demand continues to exceed supply for the 6th consecutive year. That matters more than most people realize. Because deficits don't create immediate price spikes, they create pressure. Slow, consistent, invisible pressure. The kind that builds over time and then suddenly releases. Now combine that with supply. Global silver supply is expected to grow slightly, around 1.5% in 2026. But that increase is not enough to fully offset demand, which means the system remains tight. And in a tight system, even small shifts in demand can move price disproportionately. That's not theory. That's how commodity markets behave. Now layer in institutional expectations. According to JP Morgan, silver is expected to average around $81 per ounce in 2026, but with significant volatility driven by macro uncertainty and demand shifts. Other projections suggest scenarios ranging from $70 to $90, depending on how macro conditions evolve. That range tells you something important. Even the largest institutions do not have certainty. They have scenarios. And when institutions operate on scenarios, they don't commit fully. They wait. Now bring back the macro layer. The World Bank has already warned that global commodity markets remain under pressure due to weak growth and policy uncertainty. At the same time, the IMF's commodity tracking system shows that price movements across commodities are becoming more sensitive to geopolitical shocks. That means volatility is not temporary. It is structural. Now connect everything together. You have rising physical demand, persistent supply deficits, uncertain central bank policy, geopolitical instability, and institutional hesitation. That combination does not create stability. It creates imbalance, and imbalance leads to breakpoints. Now let's talk about scenarios, because this is where everything becomes real. Scenario 1, negotiations succeed. The US-Iran situation stabilizes. Oil prices ease. Inflation begins to cool. Central banks gain confidence, and rate cuts begin. In that environment, liquidity increases. Financial demand returns, and silver, already supported by physical demand, could accelerate higher, not gradually, but aggressively. Because when liquidity meets tight supply, price does not drift. It moves. Scenario 2, negotiations fail, tensions rise again. Oil spikes, inflation returns. Central banks delay easing. In that environment, financial demand weakens. Liquidity stays tight, and silver could face downward pressure. But here's the critical difference. Even in that scenario, physical demand does not disappear. And that creates a floor. According to institutional estimates, silver is already holding a strong base around $75 to $80. So, even after extreme volatility earlier this year, that suggests something important. The downside may exist, but it is not unlimited, because the structure underneath is still supportive. Now think about this carefully. When a market has limited downside, but expanding upside potential, that is not a neutral situation. That is a setup. And setups eventually trigger. Now let's zoom out even further. Silver is not just reacting to 2026 events. It is reacting to a multi-year shift. In 2025 alone, silver surged more than 130%, driven by safe haven demand, geopolitical tension, and investor positioning. That kind of move does not happen in isolation. It signals a change in perception from a secondary metal to a primary asset. And once perception changes, capital follows. Slowly at first, then suddenly. Right now, we are still in the early stage of that transition. The market has recognized the shift, but it has not fully priced it in yet, because it is waiting for confirmation of policy direction, geopolitical stability, inflation trajectory. And until that confirmation arrives, the market will remain unstable. But instability is not weakness. It is preparation for a move that has not happened yet. And this is where most people get it wrong. They wait for clarity, but by the time clarity arrives, the move is already over, because markets don't reward certainty. They reward positioning. Right now, we are in that positioning phase where risk is high, but opportunity is also high, because the next move will not be small. It will define the next phase of this market. And the only question left is, which scenario plays out first? Because whichever one does will trigger the break. And when that break happens, it will not ask for permission. It will happen fast. And by the time most people react, price will already be somewhere else. Higher or lower, but no longer here. And that's why this moment matters. Because right now, we are still at the edge, but not for long. Right now, the market is quiet. Not calm, but quiet. And there's a difference, because calm suggests stability. Quiet suggests waiting. And that's exactly where silver is sitting at this moment. Around 75, 76, holding its ground while everything around it remains uncertain. But if you look closely, this is not stability. This is tension. And tension does not last. Because just in the last 24 hours, something important has already started to shift. Investors have begun reducing exposure slightly, pulling back ahead of the US-Iran talks scheduled for this weekend. That matters more than it looks. Because this is not panic. This is positioning. Big money is stepping back, not because the opportunity is gone, but because the outcome is not yet confirmed. And when institutions step back, the market pauses, but only temporarily. Because underneath that pause, the system is still active. Inflation is still elevated near 3.3%, one of the highest readings in recent months. Oil remains volatile, even after dropping sharply following the ceasefire announcement. And the Federal Reserve is still trapped between two opposing pressures: a slowing economy and persistent inflation. That is not a stable environment. That is a fragile balance. And fragile systems don't stay balanced forever. Now think about everything that has happened so far. Silver surged after ceasefire hopes, then pulled back as uncertainty returned. It rose on rate cut expectations, then hesitated as inflation remained high. It reacted to every signal, but committed to none. That is not a trend. That is compression. And compression always leads to release. The market is now at a point where it cannot continue like this indefinitely, because too many forces are building at once. Monetary policy uncertainty, geopolitical instability, physical supply tightening, institutional hesitation. And when multiple pressures build simultaneously, The system doesn't resolve slowly, it resolves suddenly. Now let's bring this to the present moment. This weekend is not just another news cycle, it is a trigger point because the US-Iran talks will directly influence oil prices, inflation expectations, central bank decisions, and ultimately, liquidity. Everything flows from that. If negotiations succeed, the system relaxes. Inflation pressure may ease. Markets begin to price in rate cuts more confidently. Liquidity expectations increase, and silver, already supported by tight supply, could accelerate higher. But if negotiations fail, or even stall, the opposite happens. Oil rises again, inflation strengthens, rate cuts get delayed, liquidity tightens, and silver faces pressure. Two completely different outcomes from a single event. And that's why this moment is so critical, because the market is no longer reacting to data, it is waiting for direction. And once that direction becomes clear, there will be no hesitation, because hesitation is already priced in. What comes next is movement. Now here's the part most people don't see. Markets don't reward people who wait for confirmation. They reward people who understand structure. Right now, the structure is clear. Not in direction, but in pressure. Pressure is building on both sides. And when pressure builds long enough, it doesn't fade. It breaks. That's how markets move. Not gradually, but suddenly. And when that break happens, it doesn't ask for permission. It doesn't wait for analysis. It doesn't give second chances. It just moves fast. Now step back one final time. Silver is not just reacting to this week. It is reacting to a larger shift. A shift in global liquidity, commodity demand, geopolitical structure, and financial positioning. And those shifts don't resolve quietly. They resolve through movement. That's why this moment feels uncertain. Because it is, but uncertainty is not the end of a trend. It is the beginning of one. Right now, we are not at the peak. We are not at the bottom. We are at the edge. And edges are where decisions are made, not by retail investors, not by headlines, but by the system itself. And once that decision is made, price will follow. So the real question is no longer, where is silver right now? The real question is, what happens when the market finally chooses a side? Because that choice is coming. Not next month, not later this year, but very soon. Possibly before the next market open. And when it happens, you won't hear it first. You'll see it in the price.